Joining us now on the show is Vikash Jain, who tracks the oil and gas space very closely. And of course, joining in the conversation is Somit Sarkar from our research desk. Somit, over to you.
Thank you, Neeraj. So Vikash, to start off, how were the Q2 earnings for the entire oil and gas piece? What were the misses and hits in the second quarter?
In second quarter, broadly, if you were to see the OMCs, the earnings were, core earnings weren't really that great. Nearly 80 to 90% of the PBT were made up of inventory gains. Mind you, this will turn into inventory losses in the coming quarter. On the other side, refining margins, which were anyways weaker than what we had expected for the last quarter, could actually further weaken if you were to believe the Asian GRM trends. So, it will all boil down to, with the falling crude price, if there is going to be some significant recovery in marketing margins or not. The upstream names benefited from the fact that there was no subsidy burden. The commentary from some of the companies has been that there will be no subsidy burden even in the second half. If that continues, then they should be all right. But the belief on that for the market seems to be very low. And that's why some of these stocks are also, particularly the bigger upstream names, are trading at much lower valuations. City gas names saw reasonable volume growth, particularly the non-industrial ones, the retail ones. And gas transmission and regasification, there wasn't much to write home about in terms of volume growth, flattish kind of a volume growth on a QOQ basis.
Now, earlier we have seen that the oil marketing companies were under pressure because of that government's decision. But now with oil prices coming off sharply, would you change your stance on the oil marketing companies?
On oil prices itself, we've seen a big shift from in the last 15 days itself. A confirmation by the US administration that Iran sanctions would be much more watered down has meant that all the worry which was linked to the Iran sanctions have gone away. And nonetheless, but market is still looking at the production number of October by OPEC, which was pushed up in anticipation of Iran sanctions. Commentary after that from OPEC has been largely ignored. OPEC, in my opinion, OPEC plus, that is Russia and OPEC, mainly Saudi Arabia, has an ability to put a floor on crude price, and typically they like prices around that 70 plus kind of a range is the feel that I get, listening to them. So I think, this crude, large part of the absolute price correction in crude price is over. It might stay here for some time, but clearly I believe that OPEC plus should be able to create a floor on this in the next meeting, which is not very far from now. So sometime within this calendar year itself, there should be a floor in place for crude prices. What I'm more worried about, is how do price changes happen when crude has come down? Does this lead to improvement in marketing margins or not, is something which we need to track. And secondly, what we also need to track is if crude starts improving because of production cuts by OPEC in early part of next year, that's actually a bad time for crude to rise, given that we'll be busy with elections. So those are some of the things to watch out for. What does OPEC do to put a floor, and whether marketing margins actually improve as crude prices have fallen.
Also, currently, if you see the share prices of upstream companies, they are factoring in a very high subsidy burden. So what is your view on that front? And even, do you actually expect the upstream companies to share subsidy burden in financial year 2019?
See, it is over since the budget was given out in early part of this year, in the Jan end. There's been this concern on upstream companies because the subsidy number in the budget was a very low number, and the market has been nervous ever since. However, what we wrote about this just a few weeks back, that although the market is focused on the subsidy number being lower, what the market has completely ignored, that even the revenues from the sector, particularly the upstream side of things, has been under budgeted by the government. Our recent report actually highlighted that the hole on the subsidy side could be as much as 23,000 crores or so. But on the other side, the revenue, because of higher royalty, higher cess collections, higher profit petroleum, and even if a scenario comes where these companies are allowed to take all of the profit and not put a subsidy burden, then higher dividend distribution tax and higher income tax could easily offset that 23,000 crore number. So there is no necessity for the government to kind of really bring in subsidy in this particular fiscal. The commentary from the companies has also been on that line, That from some of the government sources has also been on that line. However, investors in general, including possibly myself, who's looked at these companies for a long time, carry a historical baggage. But what we need to keep in mind is that it was very strange that all the time when crude was going higher, the bigger upstream stocks, were going down, the PSU upstream stocks. This is because people were extremely nervous on subsidies. In fact, they were so nervous that we recently wrote that one of the bigger upstream names is actually trading near its bear case value. So I think the actual outcome, which possibly should be known anytime in the next 3 months, will be way better than what the stock is currently pricing in. In case it comes out that there is no subsidy burden itself, there could be pretty big upside on some of these upstream names. So I would say the risk reward is extremely attractive, since the large part of the worst case is already in the price.
Lastly, what would drive the stock prices of upstream and downstream companies? Would it be the government policies or the crude prices?
Like I said, of course, we're talking of a crude scenario as in, things not going below, say, 45 or so, 45 or 50 or so. In that scenario, I think the worst on crude prices is already in the price for the upstream names. So in my opinion, policy is going to be the key driver for upstream names. For downstream names, the way these stocks react, it's going to be a combination of the two. However, policy in the sense that how much of the price cut is actually passed on and how much is kept in the margins. But on a day-to-day basis, clearly those stocks move a lot in tandem with crude prices. So essentially, I don't see a change in the policy anytime from here in the election to the elections. That is the government coming and saying that we are allowing them an extra 1 rupee margin, given the political sensitivity around all of this. So it's really tracking the changes in pump prices and how crude moves. But in case of upstream, policy is going to be clearly the key driver. That is the clarity on subsidy burden, which should come anytime in the next 3 months.
Moving on to the gas space. Now, if you see the 9th round of city gas auction, that was muted for all the listed city gas distribution companies. So where do you see the growth coming in for these companies going forward?
Clearly, if you look at, it depends on which geography you're talking about. But some of the ones up north actually still have some untapped areas which they have been allocated and they can really get onto to expand their volumes. At the same point of time, there is also a new geography that they've won because of a court order. So all of that should ensure volume growth in the medium term. Nonetheless, the key thing for city gas companies to watch out for in terms of volume growth as well as margins is how is the discount to competing fuels. The discount to petrol and diesel, for example, is between 40 and 60%. As long as that discount stays high, there will be more conversion that should allow higher volumes, and at the same point of time give them pricing power to maintain margins. So anything which happens to shrink that discount is what will make us worried. At this juncture, those things look unlikely. So the discount versus competing fuels is the key thing to track. That has to stay at a reasonably high level.
Now, if you see the oil marketing companies, they have also placed big bets on the city gas distribution space. So how do you see this helping them? Will it result into higher revenues, or will it just replace their fuel revenues?
No, so essentially, that's a much longer term bet, clearly. At this juncture, we don't really expect the market to recognize that at this, at the current juncture in the near term. What that will do is over the medium to longer term, in a way, if there is a shift away from liquids, given the policy of the government to promote gas, then they can definitely use their own petrol stations and ensure that those volumes do not go out of their ambit. That is, even if people move from liquids to gas, then those customers stay with them. So I think, but that's clearly a more longer term game.
With the final pipeline tariff hike expected to come in December, who is better placed? Will it be the transmission companies or the city gas distribution companies?
See, it's really, gas transmission. So in our report that we did, a big detailed report about a year or so back, we wrote about the fact that demand for city gas would double in the next 5-6 years at a time when India's demand is going to rise by about 50% or 60% or so. So if you want to play volume growth, Clearly, city gas will have a much higher volume growth than gas transmission. However, gas transmission is a more secular way to play it. So, because the fact is a large part of the, if you were to look at the current auctions, there could be several, city gas players who are not listed. So, if you want to play volume growth across the country, then that's a more secular way to play it. So I would say that it's, and you can also see that valuation of gas transmission players is also much cheaper. So it's really, if you were to bring valuation into the, into the whole investment framework, then I would say that perhaps gas transmission is better, but if you were to give volume growth is what you prefer, then city gas distribution would be better.